Welcome everyone. Welcome Jean-Luc. Welcome Rima. Welcome George. Welcome Ellen. Okay, I'll stop that now. Thanks everybody for joining us. My name is Steven Reiter. I am responsible for the options business at AvaTrade. I have a long career in options, and I joined up with AvaTrade in order to open up the options market to this entire retail audience that otherwise might not have access to options. And the reason I love options is because of the control that options give a trader over a portfolio. When you're trading with FX or you're trading with CFDs, you can only do one of two things. You can buy or you can sell. And this means you have unlimited risk in both directions until you hit a stop loss or until your margin runs out and you're forced into closing your positions. With options, you have much more control. You can set a time frame for your exposure. You can set limits on your exposure. You can trade in different ways, such as explicitly taking risk for volatility so that you can get paid for taking risk in the same way that an insurance company gets paid for selling you car insurance. So options really open up many more dimensions to our trading. The title of this presentation is Mastering Your Risk. I'm using slides that are more generic, so I'm going to skip through things. I am watching your questions, so if you have questions along the way, please feel free to type them, and I will address them at good points in the conversation. And if I speak too quickly, that's just habit. I'll try not to. You're welcome to comment on that, or you will be able to access this presentation on the AvaTrade YouTube website a few hours after the presentation as we're being recorded. I hope everyone's healthy and happy, and let's have a look at some pages in this presentation. So I started off by saying that the beauty of options is that you can take asymmetric risk, right? You don't have to take symmetric risk. So here is just a picture of trading FX. I call it a forward, but you can call it spot or cash, simply buying euro dollar. If the market goes up, you'll make money, unlimited profit potential. If the market goes down, you have unlimited loss potential. And if you go short, it's going to look the same, but opposite. It's going to go the other way from top left to bottom right. You'll make money as the market goes down, and you'll lose money if the market goes up. Here is a quick payoff diagram. We call these stick diagrams or hockey stick diagrams, comparing the payoff of a call option to the payoff of trading spot. So let me just open up my pen. Let's see, here's a pen. The call option is a little bit different than trading the forward, right? The forward has unlimited profit potential and unlimited loss potential. But when you trade an option, in this case, buying a call with a strike here, which is at the money, which means I have the right to buy an option. I have, sorry, the right to buy euro dollar at this price called the strike. If the market moves higher, I can exercise that right and participate in all of the upside. So if the market is, let's say, up here is maybe we're trading at 120, and down here is today's market level, let's say 119. If the market goes up, I'm going to profit. If the market goes down, I walk away from this option. I've paid a premium upfront, just like you would with an insurance premium. Maybe I'm paying 20 pips or 50 pips. I pay upfront. I don't have to exercise the option. I have the right, but not the obligation to buy euro dollar at the strike. So this is the fundamental of an option, the right, but not the obligation. So the most you can lose is what you paid for the option. The most you can profit is unlimited. It only underperforms the forward or underperforms cash by the premium value. Here we can put some numbers on that. This is, at the time that I made this picture, was a 1 week option. The market was trading at 115. This is euro dollar. And a 1 week option costs 60 pips, 0.006. That means that I pay 60 pips up front. If I did an option on $1 million, that would be $6,000. 60 pips on $1 million is 60 times $100 is $6,000. If the market moves higher, I profit. My break even then is that I need to cover the 60 pips So my break even is at 115.60. And if the market moves higher, I'm going to have unlimited profit potential. I'm being asked how you can learn more about trading options. We have on the AvaTrade AvaOptions YouTube playlist a full series of videos about options. And you can find all sorts of education about options online. And one of the best ways that you can learn to trade options and gain confidence is with a demo account. Open a demo account using our mobile app, which I'm going to show you in a little while. Play, trade, practice. Please practice with the demo account. I am not asking anyone to begin trading options until you understand the risks. And if you don't understand the risks, use a demo account, or at a minimum, start with buying options, because with buying options, your downside risk is limited. People often say that options are risky investments or risky securities or risky products. Options are not more risky than trading the underlying asset. As shown here, you can see very clearly the call option is less risky than the forward or the spot because we don't have unlimited downside risk. You can get equivalent risk if you sell an option, but options are not more risky than trading the underlying asset. The title of this presentation was Mastering Your Risk. So when we talk about risk in an option, the main component of risk is your exposure to the underlying asset. When you buy an option, as we showed in the previous slides, if you buy a call option, you have exposure to the market. If the underlying asset moves higher and you bought a call option, you can have unlimited profits. So your exposure, your risk is a function of the underlying asset. And the way we express that risk is what's called the delta. The delta of an at-the-money option is 50%. What that means is that an at-the-money option, if the market moves higher, the price of the option today is going to move up by half as much. The slope of this line, the orange line is the value of an option today. The black line is the value of an option at expiration. I'm going to show this to you in the mobile app. It's going to be much more clear. But the value of an option today is on this orange line. Okay, you pay an option, you buy an option today. If you turn around and sell it, you'll only lose the bid-ask spread. If the market moves higher, so if spot goes from 115 to 116, let's say to here, from 115 to 116, a spot trade is going to have a profit of 100 pips, but the option is going to have something closer to 50 pips, half of the increase. But over time, as the option starts to expire or starts to decay, then the exposure of the option or the risk of an option relative to the underlying moves to either a delta of 1 up here, 1 for 1. You see here the slope of this orange line up here is basically 1 for 1 with the underlying. And then down at the bottom, if we're out of the money, the delta is near 0 because here the option has lost all its value and cannot lose any more. So no matter what happens to the underlying asset, the option will have no change. The other type of an option that you can trade is a put option. A put option is buying the right to sell at the strike. So you buy a put if you're bearish, you buy a call if you're bullish. You can also sell options. For example, selling a call. The view expressed in selling a call is that you think the market will not go higher. You think it will stay around here or move lower, in which case you can earn the premium of the option having sold it, right? Today, you sell an option, you have no profit because the market hasn't moved. We're sitting right here. If the market has not moved as of the expiration date, the option becomes worthless and you keep this premium. But today, you have exposure. If the market moves higher, you're going to start to lose money. The delta is 50%. So as the market moves higher, you're going to start to lose money and lose and lose and lose more, just like the forward. The difference between the option and the forward is that you keep this premium. You still earn premium. So you're taking risk, you're getting compensated for it. And if the market moves lower, your delta will go towards 0. I'm being asked what's the minimum trade size. The minimum trade size for foreign exchange is 10,000 of the underlying. So 10,000 euros, an option on 10,000 euros, $10,000 yen, 10,000 pounds against the dollar. Gold, the minimum trade is 10 ounces, and silver, it's 1,000 ounces. Selling a put option looks like this, similar. You're taking exposure, you're saying either I don't think the market's going to go lower, or you're saying if the market goes lower, I'm okay with that. I'm happy to buy at a lower price and to earn the premium and to take this risk. Sometimes this is known as targeted buying. You sell a put with a strike at the level you're happy to own. So for example, you might be interested in buying Eurodollar at 112, so you sell an option with a strike, you sell a put with a strike at 112, and if the market, if the market gets to 112, you'll earn that premium. Erase the ink. I'm going to show that to you on a different slide. I'm going to, should I go over this? I'm going to skip this section. This is talking about the value of an option according to probability. It's talking about distributions and the pricing of an option. And for that, I really recommend that you watch the video, which I believe is called Options, What, When, How, or we have a number of presentations talking about options pricing. Now, we spoke about the strike of an option a moment ago. As I said, in the initial example, you can buy an option, you can buy an option with strike at the money right here. So you have the right to buy at the current price. You can also buy an option with the right to buy at a much higher price. So you can buy at 115, or you can have the right to buy at 120. Clearly, an option to buy at a higher price is less expensive. Or you can buy an in-the-money option, for example, the right to buy at 110. That's going to be much more expensive because it's already in the money. You already have value. I just want to get in here into option pricing and risk. I said that this presentation is going to be all about mastering your risk. And by the way, we're going to try to keep this presentation to about 50 minutes. We still have plenty of time. This is what's known as a normal distribution. I said I wouldn't do this, but let's do this. Let's go back over here. I'm going to move my webcam, make it a little bit smaller if I can. I don't know how to do this. Let's just turn off the webcam for a minute. Okay. What determines the price of an option is probability. The probability that the option is going to be in the money. So this, I'm going to do this in just a few minutes, give you the big picture about how we value options. And I hope this is of interest to you. Let's imagine that we have something called this lattice of nails. Some of you might have played in a pachinko parlor in Japan. Maybe you're familiar with pinball. Imagine this is a lattice of nails. Get my pen working. Pen. Okay. Imagine you have this lattice of nails, and we have 1,000 beans that we're going to drop through the lattice of nails. So every bean that we drop is going to fall, hit a nail, hit a nail, hit a nail, and every time it hits a nail, it can either go right or it can go left. And it's completely random if it's going to go right or left. And eventually, each bean is going to fall into one of these bins. Now let's imagine we drop these 1,000 beans down. No matter how many times we try this, we're always going to get this result. Most of the beans are going to drop into the center, and just a few are going to make it to the extremes, to the sides. Why is that? Because every nail, at every moment, you have a 50% chance of going one way or the other. So the probability of going to the right on every single hit is extremely low. Right? In order to make it to that outside bucket, we got to do this. It's much more likely that sometimes you'll go right, sometimes you go left, and if that happens, you're going to end up here in the center. This shape that we see here, and no matter how many times you try this, you're going to get the same shape. It looks like that. What is that? That looks just like what's called the normal distribution, the normal distribution of outcomes. Now imagine we have more time for an option, or imagine we have more nails. If we have more nails, then there's a better chance we're going to make it to that outside bin, and we're going to get a wider distribution. So what is the difference between the red line and the blue line? The blue line had more nails, more market events, more time for the market to move. So the blue line represents more time or a more volatile asset, and the red line represents our base case. What is this distribution? This normal distribution is all about statistics. What it tells us is that 68% of our observations are going to be close to the center within 1 standard deviation of the mean. It means that we're 68% confident that the outcome of the distribution, the outcome of the market moves, is going to be between between +1 and -1 standard deviation. We're 95% confident that we're going to be within 2 standard deviations, and we're 99.7% confident that we'll be within 3 standard deviations. What does that mean? Well, what's another way to look at this? Let's talk about the delta. Let's talk about this distribution. An option with a strike here at 2 standard deviations from the mean, you can go back to your statistics classes to learn more about this, only has a 3.1% chance of happening. Okay? Of all of those bounces of the bean, only 3.1% of the outcomes are going to be higher than 2 standard deviations. That means that the price of this option, or the delta of this option, is going to be also, sorry, I said 3.1, 2.2%. 2.2% of the outcomes are going to be there. So we have a very small chance, and the value of the option, or the delta of the option, reflects these probabilities. Okay, let's move into risk. I'm going to skip all this stuff, and I'm going to go into our trading platform. And actually, to go to the trading platform, I'm just going to show you the trading platform. This is my phone. I'm using the mobile app. We're about to release a web trader as well. Can someone confirm that you can see the phone, the trading platform, on the screens now? I think you can. You should be able to see them. Yes, thank you, Seth. This is our trading platform, the AvaOptions mobile app, the mobile trading platform. It works on both iPhone and Android, and we are about to release a web browser version with the same look and feel and some additional features. Thank you, everyone, for that quick answer. Here it looks like most other trading platforms where you have prices of various assets, including equity indices. On the left, we have the bid and ask. On the right, we have the high, low, and close. If I scroll this screen this way, I can see information about implied volatilities. Now, what is implied volatility? Implied volatility is the market's expectation of volatility of the asset as seen in prices of options in the market. Basically, the higher the volatility, the more volatility the market expects, and the higher the price of an option. The two things that drive the price of an option, the three things, sorry, that drive the price of an option is the strike relative to the underlying price of the asset, time, and volatility, right? Those are what drive the price of an option. So higher volatility, higher price of an option. Here's Eurodollar options for 1 month. Implied volatilities today are shown in blue. There's a 6.5% annualized implied volatility today for an at-the-money option, or it looks like 6.25%. A month ago, that option was much more expensive. You see that in red. Why was it more expensive a month ago? Because a month ago, a 1-month option included the US elections, plenty of volatility. Now that we're past the election, the expected volatility, the future volatility has dropped, and therefore prices of options have dropped considerably. You can see that in gold. You can see it basically in any asset. So that's an option for 1 month showing you implied volatility. Here are the numbers behind it. So for example, an at-the-money option, 6.3 vol, 10 delta put, which means an out-of-the-money put, 6.3 vol, and an out-of-the-money call is at 6.9 vol. We have AutoChartist chart recognition symbols, chart recognition software built into this trading platform. You can see a video about that. Here is information about the lot size. Minimum trade is 1 lot. Definition of a pip. Leverage is 100 to 1 in options for most currency pairs. And in spot, it's also 100 to 1 if you are trading outside of the EU or Canada, but in the EU, your leverage is much lower in spot trading and FX trading. Options trading still enjoys 100 to 1 leverage. So if you're an EU retail customer, trade with options, you'll get 5 times the leverage or 3 times the leverage, depending on the asset. And here's information about overnight swaps or the overnight carry for spot trading. Options do not have any overnight carry and tolerance levels for limit orders. Let's talk about options. We're here to talk about options. I'm going to click on the price of Eurodollar. I'm clicking on the ask, and this moves us to the trading screen. This is a screen showing us trading spot, not options. Down here, we have this thing, the strategy button says spot, not options. If I buy spot, if I buy $1 million and the market moves higher, I'm going to make money. If the market moves lower, I'm going to lose money. There's 1 hour of history, and each one of these candles, let's make it into a candle. Each one of these candles is a 2-minute candle. Now look at a week of history. Here's where we've been in Eurodollar for the last week. Some interesting action, trending higher. Market moves higher, we're going to make money. Market moves lower, we're going to lose money. If I go short, it's the opposite. This is showing us visually risk. Unlimited downside, unlimited upside, right? This is trading spot. We can also put limit orders by clicking the word limit, and I'll put a take profit here at 119.50, let's say. I just long press. I can type in 119.50. So I'm going to buy Eurodollar in $1 million. If the market goes to 119.50, I'll make $4,700. If the market goes down, I'm going to lose money. Somebody's asking about stock options. We do not yet offer options on individual shares. We have options on FX, gold, and silver, and we will have options on the S&P 500 and the NASDAQ in January, quickly followed by other equity indices, and then we'll work on individual stock options. So this, as I mentioned, is spot trading, right? If I go short the market, I've got to take profit down below, and I have a stop loss above. I can also put in an entry limit. I want to buy here. So this is a buying with a contingent take profit and stop loss. But forget spot, we want to know about options. Click this strategy button and you'll get a menu. And here you can choose your option strategy. You can trade calls and puts. You can trade strategies like straddles and strangles and risk reversals and call ratios. And you can play with this. Again, I highly recommend using a demo account. We also have a strategy guide. You don't know what a put spread is? Click on it. What is a put spread? If you buy a put spread, you're buying one put and you're selling a lower strike put. It looks like this. It has limited risk on both sides. But let's look instead at a call. Let's start with a call. Here is a call option for a month. If you buy a call option, the most you can lose is what you paid for the option. The most you can gain is unlimited. The market moves higher and higher. Very clean payoff diagram. This is the kind of thing you want to see. I've just taken the standard payoff diagram. We've just turned it on its side so you can see for every level of spot how much money you can make. You have here a 28-day option. We have roughly 28 days of history, and we created this range. This white arc is showing plus and minus 2 standard deviations so that we frame the risk of the trade. We can say that we are 98% confident that at the end of the option period, at 28 days later, we're going to be somewhere between these 2 white dots. That's what this is telling us over time. If you have a longer option, you have a wider period. So for example, a 1-year option is going to have a much broader, just taking a minute here for the data. Now in 1 year, the range is going to be somewhere between, I don't know, looks like between 1 and 140. But if you look at a 1-week option, you can expect the range to be between 117 and 121. A short-dated option, less expensive. If I sell an option, I'm earning premium if it finishes out of the money, and I have unlimited loss potential on the upside. So this is just like I showed you in the first page. Now, the call strike is managed with this button, the handler we call it, the strike. I can set my strike to be at the money, which is currently 119. The option costs about 45 pips. The cost 0.0045. If it's an out of the money option, if I have the right to buy at 120, it's going to cost a lot less, only 13 pips. And if it's deep in the money, it's going to cost me 115 pips because it already has value. But if you look at the trade-off between the red and the green areas, you can see that it makes sense, right? Less profit potential costs less. Much more profit costs much more. It's just a simple risk and reward profile. Now, the yellow line is showing you what's happening to the value of the option today. If I buy the option today, I can only lose my bid-ask spread. The market moves higher, I'm going to make profit. The market moves lower, I'm going to lose. The slope of this yellow line today at the money is about 45%. You see the delta, D equals 0.45, 45%. As it moves way in the money, the delta is going to be 100. Way out of the money, the delta goes to 0. And out of the money option, the delta is 0.09, right? That means that as spot moves today 10 pips, the option is only going to move about 1 pip. And if it's deep in the money, this option has a 95% delta. Basically, it looks like a spot trade. That is the most important measure of risk. Now, what happens to the value of an option over time? Today, we're on the yellow line. At expiration, our profit is either going to be on this red or the green. And you can see how an option changes over time, or how the value of your option changes over time with this button called the horizon button. Today, look at the orange line. As time goes by, the value of the option decays until you get to expiration, and now you have the red or the green. You're either losing money according to the red or making money. So today we're here, at expiration we're here. This is a very cool feature. And you can also leave limit orders on options based on the option premium, the option price. So you can say, I'm buying this option today, it's going to cost me 40.004. If it gets to 130, let's say I can put in 130. At 130, I want to put in a take profit. And that's going to happen roughly at today, that would happen at about 120.36. So I'm going to make a profit of 90 pips, right? I'm paying the 40 pips for the option, 0.004. I'm going to sell it if the market moves higher at 130 pips. I've got a 90 pip profit, but this is going to happen if spot goes from 119.05 to about 120.36. So the market is going to move up 130 pips, right? The market's going to go from here to here. That's about 130 pips in order to make 90 pips of profit. I'm not making 130 pips of profit. I'm making only 90 pips of profit. Because I bought an option, I don't participate fully because I'm not participating fully in the downside. That's all about the delta, right? Selling an option, buying an option, you can do all of this, and you can do a put option. Buying a put option, you'll lose money if the market stays here or moves higher. You'll make money if it goes lower. What is the cost of an option? I'm being asked, can we see what the actual cost of the trade is? Well, the maximum cost of the option of the trade is what you invested. In this case, it's 44 pips on a million. The most I can lose is $4,400. That's the cost of my option. The most I can gain, the profit, is shown in the green. Where it says price, between sell and buy, there's a price. I can click that. I can see the price of the option, the cost of the option in actual dollars or whatever your account currency is. So for example, if your account currency is euros, it'll show you the price of the option in euros, or in the quote currency of the option, which in this case is dollars, or you can see it in price, which is like pips, 0.0044. So I'm paying $4,400. That's the most that I can lose. Cheaper put, more expensive put. Let's look at a different strategy, like a call spread. In a call spread, I'm buying one call and I'm selling the other call. So I'm going to buy a call at 118.50. I'm going to sell a call at 119.60. The most that I can lose is $6,000. The most I can gain is $5,000. I can, of course, change that risk reward profile just by changing the strikes, changing the dates. However I want to do it, I have complete control. And the beauty of a call spread or a put spread is that you have limited downside in exchange for limited upside. This is a great hedging strategy. I'm being asked, can you close the trade before expiration? Absolutely. Let's execute this trade in 100,000. I'm going to buy, execute. And what I didn't show you, well, you can see right here, the bid offer spread is $105. It's quoted up front. We're buying one option, selling the other. We give improved pricing on one of the legs if you execute with the app and you're buying one leg, selling one leg. It tells you how much margin is available, how much margin you need for this trade. And if you really like the trade, you can click the sharing icon and share it with your friends using your phone, using your favorite apps. Okay? So we did this trade, we executed the trade. Where can we see it? Let's get into the risk part of our platform. I'm going to click on the word account value. And here it's showing me the risk of my portfolio. I have other trades on. I am long in blue, euros, the DAX, FTSE, the pound, Canadian dollar, Aussie crude, and I'm short dollars, Swiss, S&P 500, and yen. So the trade we just did was a euro dollar trade. If I'm long euro dollar, it means I'm long euros and short dollars. So this bar chart is taking all of our positions and breaking them down into their component parts to show you your net exposure from options and spot trading from euros and dollars, currencies, etc. Let me show you Vega. Vega is my exposure to implied volatility. If implied volatility goes from 6% to 7% in the pound, I'll make about $300. That's my exposure to implied volatility. Doesn't usually concern traders because you're going to take your trades to expiration most often. And here's my delta by currency pair. As I said, I'm long euro dollar, which means I'm long euros and short dollars. That's why you see that here. Where is the position? I'm going to click here on my open positions. Right here at the top, this is the trade that we just executed. I'm going to highlight them, right? I bought a call and I sold a call. This is my fill. I've lost about $110. That's just the bid-ask spread that I showed you earlier. I can scroll the right side and see more information. There's my total cost, my total P&L of each leg. When did I do the trade? And here's my exposure. The 100,000 call that I bought is in the money. It's at 115.75 and the market's trading at 119. So it has an 84 delta. I sold a call, so it has a negative delta. The net between these two is that I'm long about 65,000 of exposure. So my exposure is as if I'm long 65,000 euro dollar for today's small moves. I'm being asked if we can close the trades. I've highlighted both of them. Let's highlight just one of them. I bought this call and I want to sell it. I hit close. It puts the trade right back into that same picture. I can't change the strike anymore. I have two choices. I can change my size. I can do a partial close. And I can also put in a limit order. So here I'm just going to add a limit order on half of that position. Confirm. It's done. And there you can see it. I own 100,000 call and I have a limit order to sell 50,000 at, slide this over. I have a pending order to close half of it at what price? I think it's 108, 0.08, but that doesn't make sense. We'll see it in a minute. So we have a limit order in blue. It's cool, it's waiting, so it's in blue. So limit orders in blue, and you can see this is attached with this arrow. So this is selling a call, and you can do partials. So I can do another limit order on 50,000 more at a different price. Let's do it in here. I can only do another 50. So let's put it, instead of in dollars, let's look at it in price. Yeah, so let's put it a limit order at 0.07. So it is correct. A limit at 0.07, and I'll put in a stop loss as well at 0.007. I'm placing both of them. And now we're going to see we have both. We have 2 limit orders to sell above and 1 stop. And you see these prices. These prices were correct. Pretty cool. And of course, I could just close it outright, in which case those will disappear. So let's talk about risk. Risk Manager shows us the same numbers you saw in that bar chart. Now you can see them by currency pair in euro dollar here in the second line here. In euro dollar, I have 26 open positions. My net delta is about 200,000. 70,000 is from cash or spot trades. 125,000 is from options. In dollar yen, I've got 9 positions. I'm long 90,000 yen from spot or cash trades, and I'm short 77,000 from options. And in the desktop, the upcoming web trader, you'll be able to see scenario analysis and see how your portfolio looks over time. That'll probably be a new webinar in the next 2 weeks to explain how to use the new web trader. So that's risk management. And you can also, whoops, there's more lines in here. So here's all our risk. Here's history. So here are the trades that we've done today. We did 1 open buy and 1 open sell, and then we put 3 limit orders in blue. Closed trades, I've not closed anything today. If I close 50,000 of this one, instead of 100,000, we'll close 50. Hit close, execute, nice and quick. So that trade is now only 50 instead of 100, right, this one. And if I look at closed trades, there it is. So you've got everything in the palm of your hand, a very neat platform. But the main thing I want you to understand is delta. What's the net risk of my trade? In dollar yen, I'm short from options and I'm long in cash. Let's look at euros. I'm long 200,000. I don't want to be long 200,000. I want to flatten my exposure. That means that I need to sell 200,000. I want to sell this out, sell out this 200,000 so that my net exposure is 0. My option delta is positive 135. My cash is positive 70. If I sell 200, then my exposure is going to go, my net exposure is going to go to 0. I'm going to hedge my exposure at the current price, at the current level of the market. Let's go do that. I'm going to come here into euro dollar. I'm just going to sell 200. This is what it looks like. Wow, spot's popping higher here. Execute. Wow, that's nice and quick. Let's look at the portfolio. My euro exposure now, oops, sorry, I meant it's here. Now my euro exposure has gone to almost nothing. I've temporarily hedged my position. I'm long from options and I'm short from cash for a net 0 risk. And I can show you what that looks like in the desktop platform. In the Windows platform, you can do it, and also in the web trader, you can do it. You can see what that looks like overall. Let me have a look at a couple of questions. Looks difficult, Mr. Hassan. All you need to do is open that demo account and trade and practice. Doesn't have to be difficult. It doesn't have to be complicated. Keep it simple. Just buy a call, buy a put to take your exposure. Keep it simple. You don't need to do all this hedging stuff unless you want to reduce your exposure. The other way to reduce your exposure, of course, is simply to close positions. I can say, I have all this dollar yen. I've got 9 positions in dollar yen. I want out. I want to close my positions in dollar yen. Come here to open positions, long press on the top row, choose only my dollar yen. I've got all kinds of filters here. I'm going to look at only my dollar yen positions. Here they are. And I can choose them all and close them all. Close everything. This won't be quite as quick. Well, pretty quick. Those are all closed. And now if I go to the risk manager, I have no more dollar yen risk. Pretty sweet. So that's the platform. I wanted you to understand risk. Here's my exposure, my net exposure from options. Here's my net exposure from spot. Here's my total exposure. Doesn't have to be complicated. It does look nice. I've got a compliment from Musa. Thank you very much. We've worked hard on this platform. It's my pride and joy. But what's also really great about it is it's flexible, and it really is geared towards options traders. We've got a lot of information in here. Here's overnight options, 1 week options, 1 month options. It's a very flexible platform. And by the way, you also have charting, which more than what you need for a phone. You've got indicators like moving averages and Bollinger Bands and whatever tickles your fancy. You can add them to your chart. Very easy to manipulate, and I encourage you to use them. But really, I honestly beg you to use demo accounts. Understand the product before you start trading, because this gives you tremendous flexibility and tremendous power over your portfolio. It gives you ways to express your view. I'm just going to go into one. I'm being asked about the minimum account size. Minimum account we recommend is $1,000 or 1,000 euros. Options on small sizes, like an option on 10,000 euros, euro-dollar. Here's a call in price. It costs $40. It doesn't cost a lot. So if you're buying options, you don't even need $1,000. You can trade with less. If you want to short options, of course, you need margin. So I do recommend at least $1,000 in your account or 1,000 euros, but you can open an account with less. What else do I want to show you? As I mentioned, we have a web trader coming with the same look and feel. So watch out for that announcement. You got other things you can see on the screen. Just a little hint. This little green is showing you how much margin you're using out of your total available. So it looks like this account is only using like 5% of its available margin. It's in green. If you start to get into trouble and use more and more margin, it will eventually turn red. Just a little bar chart. This will turn red and you'll eventually not be able to add more positions. You can always close positions. Here's, if I click that number 6, that's showing me auto charter signals. It says that there are 6 current auto charter signals. In the 15-minute chart, there's a signal channel up saying that we have a bullish, it's green. I'll click this one. You get a little picture of this automated chart recognition. There's a whole video about this. On the 15-minute chart, it recognizes that there is an upward channel, and therefore it's a bullish signal. It recommended here at this point to buy. If you agree, it gives a recommended stop loss at 118.80. If you agree, just click trade. It will open up the trade with the stop loss right there at 118.82 that it recommended, ready to go. So if you agree with their recommendation or the suggestion from chart recognition software, it's pretty cool. I'm being asked about gamma. We don't show gamma in this trading platform because gamma is often misunderstood. There are many different measures of gamma. Gamma is the change in delta for a given move in the underlying, and you can see gamma simply by the convexity of a strategy. So for example, if I do a straddle has a lot of gamma. In a straddle, we're buying a call and buying a put. Let me do it for a month. So you're buying a call and buying a put. Let me put this back to today. Whoops. To now. So you can see here, there's a lot of curvature in this yellow line. The delta is changing rapidly from 0 at the money, and it'll either go to +1 or -1. It has a lot of curvature. That's called gamma. So I can see my P&L, by the way, in dollars or in price. I can change my strikes. I can buy a straddle, sell a straddle, but we don't generally show gamma on this platform. You can see it in the desktop Windows platform. It's just that it's a number that's often misunderstood. When you buy options, you're long gamma. When you sell options, you're short gamma. We also have strangles. Let me just show you one of my favorite trades. One of my favorite trades is simply selling a strangle. Selling a strangle looks like this. When you're selling a strangle, it means you're selling a call and selling a put. The beauty of a strangle is that you're selling two options, which means you're earning two premiums. You're earning a premium from selling the call, and you're earning a premium because you're selling a put. So you're earning 40 pips on this one and another 40 pips on this one. You're earning 80 pips. But what's neat about it is that you can't really lose on both sides. At the end of the option, either we're going to be up here, right? Either we're going to be up here or we're going to be down here, but you're earning two premiums. So if you believe the market is going to be range bound, if you think the market's going to stay within a range, your break-evens are 120.25. Let's put the strike at 120.50. And let's put this strike at 118. Whoops. Let's put this one at 120. 118 and 120, I'm earning $80 or 80 pips. Since this is 10,000, I'll put it in, here's in price, 0.008. So my break even is either going to be 120.80 up here because I'm earning 80 pips of premium. So my break even here is 120.80. My break even here, is 117.20. So if you think the market's going to be range bound between 117.20 and 120.80, you can do this trade. You're profitable in that range, that's in green. And if the market moves higher, you've still got great break evens because you've earned a lot of premium. That is a strangle, kind of like it sounds. You're strangling the price. You can buy a strangle, but then you're buying two options, but you don't really need them both because they're not both going to finish in the money. You buy strangles if you think the market's going to be very volatile today and you want to profit from the increase in implied volatility. But that is a less common strategy, I would say, for a retail trader. But what I showed you here by selling options, one of the beauties of the options trading is that you can earn money from your view that the market won't be volatile, right? You're earning money because the market is quiet. You can't do that in spot trading. If you only traded an MT4, you can't make money from the view that the market is going to be range bound unless you're taking a lot of risk. For example, market moves higher, you sell, market moves lower, you buy, jobbing and buying in and out and in and out. With options, you can be much more explicit about your view and say, I think we're going to be range bound, or you can say, I don't think we're going to go higher. So you sell a call and you decide how much risk you want to take, or you can buy an option and have limited, known, defined risk without needing any margin. If you buy an option, you pay for the option with cash, that's it, no margin required. So with that, we're at 50 minutes into our presentation. I hope I wasn't too disorganized. I hope I gave you a good taste for understanding risk and the risk of a portfolio and why options are not more risky than spot trading. This is called a butterfly. You buy the straddle or buy a call and a put and then sell the strangle, which means you're selling the call and selling the put. You think the market's going to have a move, you just don't know which side it's going to go to. But if you move your strikes around, you can really create any kind of risk reward profile that you'd like to have. For example, something like this, where you have a lot of upside, twice as much upside as your downside. The most you can lose is what you paid for the option, $250, but your profit potential is much higher. You can even take a little more risk and try to get that up to double. So you've got a lot of flexibility to structure a trade however you like, and you can close legs, you can close partial legs, you can put limit orders. You've got great flexibility. Musa is asking if it's better to choose the predefined strategy or better to do it manually. If your intention is to do this strategy, like this multi-leg strategy, you should use this interface, use the strategies, because we're buying two options and selling two options. We give you an improved price when you trade this way. You see here that it says improved 0.0017, improved 0.0017. That means that you are better off with this strategy. You're going to save 3.5 pips executing this way, as opposed to going outside and executing one leg at a time. So you've got improved pricing for executing a strategy. That's how the professional options markets work, because we know you're buying one option and selling one option. You're taking less risk, and therefore you should have less bid-ask spread. If you like the platform, please visit the websites, download the platform, and please give us a review. Tell us you like it, give us a thumbs up, or whatever it is. Give us a nice review. That's always nice to see. At least I can show my mom that somebody likes all the work that I do. So please start with a demo account. Go for it. Trade with this thing. You can trade spot, you can trade options, and you can trade, as of now, you can trade equity indices. These are futures-based equity indices, the main ones, and we are working on adding options on the equity indices. We don't have them yet, but we will have them soon. And you can also trade gold, options on gold and silver. And yeah, that's that. There's gold. Gold is very popular, moving around a lot. And again, you can trade spot or options. And one great advantage when trading spot is that you can leave partial limit orders, which you cannot do in MT4. And you also have this really nice interface to see visually, very quickly and very easily, the impact of a take profit or a stop loss. How much money you'll make at whatever level, just do a long press and you can put in the level explicitly. Okay, so that's it. Any more questions? You can trade options, Mike, you can trade options from the minimum expiration is 1 day. Options always expire at 10 o'clock in the morning in New York time. You can trade options from 1 day to 1 year. You can see that right here in the expiration date chooser. You can go from overnight, which is 1 day, down to 1 year. In gold, actually, sorry, this is gold. We only go to 6 months, but in currencies, we go to 1 year. And you can choose any date in between as long as your trade size is at least 10 lots. So if I change my size to 10 lots of options, sorry, that means 100 ounces, 10 lots is 100 ounces. Everything now is in blue, I can choose any date. Or if I do that in a currency, euro dollar, trade an option. Trade size is 100,000. I can choose any day from 1 day to 1 year. What is a less risky time period? Well, 1 day is less risky than 1 year, but you get what you pay for. And that's the whole point of options. A 1-day option is priced for 1 day of potential market move. A 1-year option is priced for 1 year of market move. So the 1-year option is, I don't say it's more risky, although if you're buying the option, you have to put up more cash. So if you're buying an option, less risky, well, less time is less risky, but it's all fair, red and green, risk and reward. So they're all priced for the amount of risk that you're going to take. The most risky thing is to sell options. But just looking at that picture, it's no more risky than trading spot. Trading spot is unlimited exposure. Trading options is also unlimited exposure with, but you at least get paid for taking that risk. Thank you. I'll give my mom the message. Thanks, everybody. We're out of time. This is being recorded. You'll find it online on the AvaOptions playlist. You'll also find it in the AvaTrade webinar playlist. It'll probably be posted tomorrow. There are lots more videos, and you can access them even from inside of the app. In the top left menu, videos, you see them here, and you can see there are a whole bunch of webinars in here as well. So I really encourage you to take the time. Better to watch this on your computer screen, not in the app, but if you really want to, you can watch it in the app. Thanks again, everybody. I'm gonna end the presentation now, and we'll see you next time, hopefully in a couple of weeks, and I'll be able to show off our web trading platform. Bye, stay safe.